So there are two, this is my template, Tom. So there are two methods of accounting that we're going to look at, but like I introduced to you just before, we're really only going to be concentrating on one, but it's important that we acknowledge the fact that there is an alternative, and that's the cash accounting method. What we are going to be spending time on for the rest of the unit is on accrual accounting. So I know you've got your workbooks with you, so as we go along, can you please just check to see what you need to complete so that we can have an accurate record of all these concepts. So cash accounting is one method of accounting that we are going to look at. And basically cash accounting acknowledges the fact that transactions are recorded only when cash is received or paid. And we kind of do that in what we've been working on so far. Expenses are only ever recorded when you pay them. That doesn't mean that there's not an expense that is lying there waiting to be paid. We only record expenses in the account when we pay them, but there may be an expense owing. That expense is only going to come into our records when we pay that expense. Likewise, with revenues, we only record revenues when we receive them. That doesn't mean that a revenue is not owing to us. That doesn't mean that we haven't earned that revenue. The person who has benefited from a service or a product that we've supplied to them may not have paid us for that service yet, but we have definitely still earned that revenue. So in cash accounting, that's all we're concerned with. We're not concerned about that, have we earned it or do we owe it? We're only concerned about have we received the revenue and have we paid for it? No other consideration is made. So credit sales and purchases are recorded only when cash has been received or paid, and when we come to calculate the profit, we only consider what revenues have been received and what expenses have been paid. In fact, those exercises that we've been doing, 2.6 and 2.7, have only accounted for this method of accounting. Have we received it? It's in the revenue account. That's what we use to calculate profit. Have we paid it? Is it in the expense accounts? That's what we take away from our revenues to determine that profit.
What does adhere mean?
Adhere means applies, or means attached to, or enforces the matching principle. So this particular method of accounting, cash accounting, does not apply the matching principle, does not abide by that matching principle. And remember, the matching principle is an acknowledgement that profit is determined by matching revenues earned to expenses incurred. Have we earned the revenue? Then we've got to use it in our profit determination. Have we incurred that expense? Then we've got to use that in our profit determination. And what you need to know is that I think I've done this wrong, actually, this video, so I'm going to have to scrub it. What you need to know is that it does not comply with the ATO. Okay, so you can't apply the cash accounting method in Australia and be fulfilling the Australian Taxation Office's requirements. You must use accrual accounting, and that's what we're going to look at now. So I'm going to keep on going. I'll still upload this video, but what you'll see is a different version of the PowerPoint. So accrual accounting here, let's have a look at what this is. Accrual accounting recognises transactions and events when revenues have been earned and when expenses have been incurred. For example, we may have earned interest at the end of the accounting period. Like, for example, if you've made investments, and if I have invested in something, sometimes I only get that interest at the end of the investment period. So that investment period may not coincide neatly with the end of the accounting period. And if it doesn't coincide neatly, then I haven't received that revenue, but I have still earned that interest from my investment. Now, if I recognise that, if I say, hey, I haven't received this revenue yet, but I have earned it, therefore I need to make an adjustment as a result, then that is the application of the matching principle. In my interest revenue account, I've got no interest recorded for that revenue I've earned, but I need to recognise that I have earned it. I need to make an adjustment. That's me applying the matching principle. So it's important for businesses to recognise revenue. Recognise when revenue has been earned. So recognising revenue means that although your cash may not have been received from the revenue, it still means you've earned it. And why is it important to make that distinction? Remember, it's because in accounting you only record in the revenue account the fact that that revenue has been received. So just like that interest example, you may not have received the interest, but you've still earned it in the accounting period. So what we need to do at the end of the accounting period is we need to recognise that the revenue has been earned. And the way we recognise that that revenue has been earned is through making certain adjustments. Realising revenue occurs when cash is received. So we've earned this revenue. We eventually will realise that revenue when we receive the revenue. And that's when it's recorded by the business. So realising revenue occurs when you've earned the revenue and then you eventually receive it. That's when it gets recorded in the accounts. So what I'm going to move on to talking about now is how we can actually make that happen. How can we recognise revenue as being earned in our accounts at the end of the accounting period, or expenses which have been incurred in our accounts at the end of the accounting period when we haven't actually received it or paid for it in the case of expenses. And I kind of alluded to the fact that we need to make adjustments to those accounts, and those adjustments are called balance day adjustments.
Whoa.
So balance day adjustments allows the matching principle to be carried out. So without balance day adjustments, you're not going to be able to apply the matching principle. Adjustment entries will help a business apply the matching principle so that we can match revenues earned to expenses incurred. What it's going to mean for you as a business owner or an accountant working for a business is that you're going to be able to ensure that you're going to record for that business a more accurate figure. So if the owner walks away and says, hey, I made a $250,000 profit this year, then they can be satisfied that indeed they did make that profit in the year, and that they're not including revenues earned from previous periods, or that they've accounted for all revenues that have been earned but may not necessarily have been realised or recorded. So it's essential that we apply this, because if we can't be satisfied that our profit has been calculated accurately, then all future decision making will be compromised. because it's on the basis of that income statement and that balance sheet. You know, what does that income statement tell us about our business? What does that balance sheet tell us about our business? It tells us how we've performed in the past, and it informs our future decisions. If those future decisions are based on poor records, then you're going to compromise your business's performance in the future. So it's really important that you can be confident that the profit that you are recording is accurate. And the application of the matching principle requiring adjustments made to those accounts is what needs to occur. And that way you're going to ensure that reports will be more relevant and more reliable. Okay, so when do we actually perform these adjustments? Adjustments are carried out on balance day. Now, most of you may recognise that based on our discussion with regards to the accounting period assumption, when is balance day likely to occur? What date would balance day be?
June 30th.
Exactly. 30th of June is balance day. The end of the accounting period is when these adjustments occur. And these adjustments need to occur before we close revenue and expenses off to the P&L summary account. So that's the process we've done so far. We've closed off expenses and revenues to P&L summary, but this step that we're going to include on adjustments has to happen before the closing entries, because we need to close revenues earned and expenses incurred, not just revenues received and expenses paid. So balance day adjustments, what are they? The definition for them is that they are general journal entries that are performed on balance day in order to match revenues and expenses accurately, so that we can be satisfied that the profit determined as a result is profit that we can use for decision making, and also that we can compare profits between periods. Because that's what businesses do. They're going to look at the profit that they made this year. Is it more or less than the profit we made last year? So you need to be satisfied that the way you go about calculating that profit is going to be comparable to the last year's calculation of profit. And you know it's going to be comparable if you apply this matching principle. Okay, so there are a number of balance day adjustments. I think there's probably about 7 in all. We're going to do 4 in this unit. And those 4 are 2 related to expenses and 2 related to revenues. And they are prepaid expenses. These are adjustments made to expenses that are considered to have been paid ahead of time. Accrued expenses, an adjustment made to an expense account where the account does not reflect the expense incurred for the period. We actually owe an expense, but we haven't paid for it yet. Unearned revenues. Sometimes businesses can receive revenues or can actually receive the fee in advance before they've earned the revenue. So the business hasn't supplied a service yet, but the customer has paid for it in advance. Sometimes deposits are made ahead of time before the service is completed. That's a revenue that has not been earned. And finally, accrued revenues. Revenues that have been earned, but we haven't received the cash for it yet. We haven't realised that revenue as yet. So they're the 4 balance day adjustments that we're going to be looking at.